So good morning, friends. My name is Parag More. I'm a part of Emkay Wealth Management. I heads the sales part of wealth management. Today we have with us some of our colleagues from Emkay Wealth, Mr. Ashish Ranade, who heads the products. We also will be joined shortly by Dr. Joseph Thomas, who heads our research and advisory. Uh, I will quickly take you through, the Emkay Wealth's journey. So this is how the AUM trend has been. As you all know, in the industry, last 2 years has been a lot of focus on the non-AUM part, and I think with SEBI's recent regulation, I think looks like we will go back to the old style of doing wealth management in terms of asset allocation, so on and so forth. But yeah, exciting times. I think the recent SEBI regulation has only brought in the sanity in terms of managing wealth of the high net worth individuals, and that will only help industry grow in a systematic and structured manner. And will be happy to be a part of that growth story. That's how the AUM trend has been. We see a lot of opportunity this year in terms of AUM growth, primarily because the business has now been realigned with the current state of regulations. And while we have grown our asset about 10 to 15% year on year, we are witnessing a spike in the asset growth in the first quarter itself, and we hope to see that spike continuing in the quarter 2, 3, and 4. That's on the AUM side. Can we go to the next slide? On the client trend, at Emkay Wealth, while we have not only mutual fund as a part of our but we have varied products, both internal and external, and that helps the uniqueness in terms of products and the product selection process that we follow at Emkay only helps us acquire quality clients on a very, very regular basis. And today we have more than 2,000 customers that we actively manage, and we are extremely happy to see the confidence that clients are posing into Emkay Wealth Management proposition. So very healthy growth in the client acquisition trend. That's all this slide can say. Next slide. So this is I think when we met last time, we were at about 10 crores last year. We've closed that year at about 15 crores. Now, this year, we are at about close to 17.5, 18 crores. So there is a growth of 16, 17% year on year on the revenue side. Next. Currently, we are, located at this, locations, 10 locations, prima facie. We are also now trying to look at some of the very, very smartly developed markets in the tier 2 category, and those cities have really been coming up and have come up quite well on the wealth management geography. And as an aspiring or as a growing wealth management platform, it is only imperative for us to look at those markets. So we are calling it as an up market or upcoming market category. So you will see, we will be adding a couple of more locations in this category. So one of the locations that we recently added is Nashik. We are looking at a couple of more such places wherein we are witnessing a spurt in the HNI category. I'm not saying that people are getting richer in this city, but their appetite for some of the wealth managed solutions or products that we generally see high demand in the tier 1 city. We see a lot of appetite in these kinds of cities, and hence I see a growth coming in tier 2 cities. I think the time of tier 2 cities is here, and we as a growing Emkay Wealth, a growing wealth organization, will be up there and will be happy to grab as much of the market share as possible. So that's on the geography side. To quickly introduce you some of the other members apart from Ashish Ranade, who will take over from me after my introduction. We have Ashish Studio, who heads the strategy and new initiatives. Next slide, please. These are my sales team at zonal level. We have Alok Singh, who heads a part of West India. We have Aurobindo Roy, who heads the Eastern market of India. Eastern market of India for us is extremely exciting, primarily because of the pedigree that our promoters have had. Our institutional and broking business has been a very thriving business in Kolkata, and we only help, we are only, glad to leverage the strong pedigree that we have in the Kolkata market, apart from Mumbai market. South has been the a great market for us, in terms of growth. So Santosh Nikat, who has a long-standing experience in the industry, heads that. We in South, we are currently present in Bangalore, Hyderabad, and Chennai. We hope to look at some of the upmarket or upcoming market in the South market as well. That's about South. Vikram Chokar has been a new addition who joined us recently, about 7-8 months. When we spoke last time, Vikram was not on board, so he heads our North market. For us, North market is extremely important and contributes to about 25-30% of our top line and bottom line. So that's about North. Apart from this zonal heads, we also have Shriram Singh. Can we go to the next slide, please? We have Shriram Singh, who also recently joined us from IFL. He was an ex-IFL, ex-HDFC. So he joined us to head some part of West. So he kind of helped us start Nagpur location, and we've been quite successful in Nagpur so far in the past 3-4 months. So that's a good news on the location success story side. And we continue to have Namita Agarwal, who heads our succession planning. We've written close to about 200 wills last year. We set up more than 15 family trusts. And that's been not only a great service to the HNI community, but also helps us acquire customers on the wealth management side. So we've been doing a lot of road shows with Namita, a lot of educational, sessions with Namita, with our customers, and so on and so forth. So, that's, so Namita as such is a very, very important cog in the entire Emkay wheel. So that is a brief introduction of Emkay Wealth Management, how it has been panning, how are we, positioned in terms of the next opportunities that we see in the Indian wealth management industry. How is our team strengthened in the last 1 year that we've spoken, and we are quite excited to look at future in the next couple of years. You will see Emkay Wealth as a strong player in the wealth management side. I would call my team as a rising star on the wealth management horizon, and looking forward to see you next time with greater numbers. And thank you so much for this time, for being here. And with this, I hand it over to my colleague Ashish Ranade, who will take us through our view on how are we looking at markets on the equity front, as well as on the research, as well as on the international front. And that pretty much sums up the way we are advising our customers in terms of their portfolio allocation, the positioning of their portfolios with regards to the opportunities that are lying in the domestic as well as international market. So thank you so much for your time, and over to you, Ashish. You seem to be on mute, Ashish.
Thank you, Parag. So the question on everybody's mind is what next for equity? We've had a very good run as far as equity markets are concerned. And over the next couple of slides, I'm just going to take you, through our view in terms of how we see the various asset classes and where we are, seeing pockets of growth. Amit, if you could move to slide 15 on global macro. Yeah, the next one, please. Okay, so how we got here. Number one, post-COVID, there was a huge amount of liquidity which came into the markets. Interest rates were low, and compounded by the fact that the world was in lockdown, there were supply chain issues. which led to a huge rally in commodities, and it had its domino effect across the supply chain and various products and services. And as a result of which, US saw the highest ever inflation in many, many years. And this spread across the world. So we had a very good rally in equities at that point in time, but then the Fed had to respond. The stimulus had to be reduced and interest rates had to rise. Now, when all of that started happening, the resultant effect is going to be a slowdown. Unless you have a slowdown, you're not going to get energy prices down, commodities prices down, and inflation down. The good part is we seem to be coming to the last phase of the interest rates rally. Commodity prices for most commodities and energy have started falling. There is a normalization of supply chain. I mean, China, which was in lockdown till last year, has opened up and supply chains have resumed. So as a result of which, we are expecting 2023 to be the worst, or rather the bottom, as far as the global growth is concerned. And the global growth is expected to bottom out in calendar year 2023 at 2.8%, with a rebound to 3% in calendar year 2024. Next slide. Now, clearly, as a result of all of the actions which the Fed has taken, global growth has been coming down. And if you see on the slide on the left-hand side, that's the JP Morgan Global Composite Output Index, which is clearly showing us that the Fed actions are working. The latest IMF projections on the right-hand side confirm that 2023 could be the bottom, and 2024 is likely to be a bounce back from a global growth perspective. Next. So if we look at this growth, again, projections by IMF tell us that the US market is likely to bottom out in calendar year 2024. And that seems to be a possibility, given that, Fed is, and when Joseph Thomas comes and talks to you about his view on interest rates, we are expecting a long pause from the Fed, because the inflation target at 2% is nowhere in sight. I think it's going to take at least another 6 to 9 months for that target, in US to be achieved. But the good thing is the rest of the world is likely to recover much faster. Middle East and Central Asia, 2023 is expected to be the bottom. Euro area, which was in recession, again, expected to bottom out in 2023. Africa and Latin America all expected to bottom out in 2023. So now, in next slide, please. If you look at, the world today in terms of the IMF projections for 2023 calendar year and 2024 calendar year, what we see is India stands out significantly in terms of growth. So from a bounce up point of view, 2024 is calendar year 2024 is expected to be a very good year for India. And I think this is a point which all the investors across the world are noting, and which is why we are seeing some inflows come in to India. Next slide, please. The good thing is, because of the Fed hikes, the global inflation is coming down. And so if you can see on the left-hand side, that's the chart for the headline CPI inflation across the Euro area and the United States. And you can see, clearly see that it's coming down. The problem is, and one of the reasons why we believe that, the Fed will be on pause for a long time, is that the core CPI inflation is not coming down as aggressively as, the headline CPI inflation. And I think that is one of the reasons why we feel, it's still another 6 to 9 months before there is any downward action on interest rates from the Fed. Now, in all of this, next slide, please. On the domestic macro, there is bound to be, although India is growing faster as compared to rest of the world, growth is no doubt slowing down. And here also we had a situation that, there was a stimulus and there was liquidity pumping in and there was interest rates reduction when COVID happened. And as a fallout of that, we had superlative growth. The numbers looked excellent. And then, tandem with the Fed, India also had to start increasing interest rates. Also, India is no longer insulated from the rest of the world. So, if the world slows down, it is going to have some kind of a knock-on effect as far as India is concerned. And to make matters worse, if India is the fastest growing economy in the world, you are going to have an import-export balance problem. Imports are going to go up. And, with US and Europe slowing down, exports are going to be falling. So the external situation can be one concern going ahead. The second concern at this point in time would be the monsoon worries. The El Nino effect is likely to play on, and I think we are already experiencing a huge delay in terms of the monsoon reaching the coasts of India. But there are some very positive factors at this point in time. The banking sector health is very good. Credit growth is very good. The private sector capex is starting to look up, and that's very positive for the economy. Tax collections have been good, and that is, allowing the government to spend on infrastructure creation, etc. And I think these are the positives that are, taking us to a good growth situation. But the fact of the matter is that FY24 is going to be slower than FY23, which was slower than FY22. So from a growth perspective, we are tapering down, and that's not a surprise because we do not live in an isolated world. India is connected very strongly with how the world functions today. Next slide. Now, when we track the manufacturing PMIs and services PMIs for India, we are almost at a 10-year high from the services PMI perspective, and manufacturing also indicates that we are in a very strong expansion mode. So this kind of reconfirms the fact that things are good on the ground. Next. Next slide, please. As I said, credit growth is picking up. So these are a couple of slides which tell you about, that we are at 15.7% in terms of credit growth. I think that's fantastic. Next. Inflation, not a problem for us as much as it is for the US. So you can see here that inflation is coming down on the left-hand side, and our expectation of inflation over the next 1 year on the right-hand side. So this is going to give a good amount of leeway, for the RBI to possibly take an action, follow a path which is different from the Fed. We've already seen RBI stop hiking rates much before the Fed actually did. And, the Fed is at this point in time not very clear in terms of whether that, it's a pause or maybe one or two more hikes can follow. I think they've left it open at that. Next slide. This growth story for India is clearly started in 2019 when, the government introduced Make in India, and the first. So this was pre-COVID. I think the intentions were very, very clear. The first round of benefits or triggers from the government was when they reduced taxation for companies which were setting up newer manufacturing units. I think it was brought down from 35% to 19% or so. And that followed by the entire Make in India, for defense, all the defense offset contracts, had a clause that whatever equipment was being procured, within 3 to 5 years has to be manufactured within India. The same thing was done for all the railways procurement and the PSU procurements. And then the PLI schemes started, which gave specific incentives to certain target sectors. And in addition to that, on the next slide, you will see that the government itself, apart from the incentives, has been following up by giving spending more in terms of capex. So that's where we are as far as the global and the domestic macro is concerned. Now, clearly, when we look at the markets, we see that all of this has been reflected in market performance, because markets typically tend to be forward-looking. Next slide, please. Next one. So in India, we've had a massive rally post COVID, and the last 1 year has more or less been consolidation. The equity markets have been flat. And unlike last time, whenever there is consolidation, the consolidation is more in the large caps and not so much in the small and mid caps. But this time, the small and mid caps are also holding up. And in fact, some of the small and mid cap companies have actually done much better than their index constituents. And I think I'll come to our view in a bit. But during this period, the US markets has has followed a completely different trajectory. You could move to the next slide. Amit, next slide, please. Next one. This is the previous one. Not this one. Yeah, the one after this. Yeah. So here I have the NASDAQ and the S&P 500. And if you can see, the NASDAQ took a big tumble as the Fed started increasing rates and global worry started coming to the fore. But the bounce up in NASDAQ has been fantastic. And I think this, to some extent, reflects the fact that equity markets are seeing 2023 as the bottom as far as the world is concerned. And today the NASDAQ has constituents, companies which are not so much dependent on the United States alone for their revenues. In fact, many of the companies are today, generating more than 40% of their revenue or more of their revenues from across the world. And I think that is reflecting somewhere in, the way the NASDAQ has bounced back. As compared relatively, the bounce up has not been as sharper as in, in the S&P 500, which has a whole lot of manufacturing and retail and domestic consumer plays within the United States. The fundamentals of India clearly reflect in the profitability for our top 50 companies. And, being the barometer in terms of the overall, health and state of the markets, we are seeing a steady secular increase as far as the profitability of these companies is concerned. And I think somewhere, next slide, this is also being reflected in the positive flows that we are seeing from FII. So if you see on the chart on the left-hand side, the black line is the net flows of FII and DIIs together. And if you can see that, for a long period of time, it was in the negative zone. This is post-COVID, I think second part of 2021 and most part of 2022, the flows were negative. But of late, the flows have become positive. And this is kind of reflective of the fact that we are going to be the fastest growing economy in the world, and the confidence from the domestic investors in terms of the SIP flows, amazes in terms of the way the monthly numbers are growing. And somewhere this is reflecting in the way the markets have performed. Now, from a valuation perspective, we are relatively expensive as compared to our historical averages. But the way I look at it, or the way we look at it, is that this is an India which is very different from what it was, say, 10 years back or more. So it's okay to be a little expensive as compared to the historical averages, because we are going to see significant growth in terms of not just the domestic sales but the export sales for most companies, driven by, call it globalization or China plus one strategy or make in India or whatever benefits the government is providing. So from that perspective, there is still support for high valuations in India because of this high growth. Domestic investors continue to put money in Indian equities in spite of the fact that interest rates have been high for quite a long period of time. The FII buying also is very positive, and especially the last month, if you see, the numbers have been good. Our tax collections have been good. Consumer data is indicative of good growth in the financial year 2024. And I think somewhere we are reading that the RBI decision to take out the 2000 rupee note is leading to high velocity of money within the economy. People are using their 2000 rupee notes for purchases, and a whole lot of the notes which were lying idle have started coming out in the open. And I think that was an effect we had seen in during and post demonetization as well. And I think everybody that we talk to is reporting that yes, there is some momentum which is there in the economy because of that. Now, while we say that the markets, the broader markets are expensive, there are many companies, and India has the benefit of having a very deep market. We have more than 2,500 listed companies, and the mutual funds typically focus on the top 500, but beyond 500 there are many companies now which have reached a significant size, and many of them are benefiting because of the government policies, because of the change in environment, because of the change in business metrics. And I think these are the ones where we see a good amount of growth. The cyclicals which performed very well till last year, I think the market is going to move more to the structural ones. The structural ones which were dependent to a large extent on, which got impacted rather because of raw material price increases, etc., I think will benefit because of, the raw material prices and commodities coming down. So that's the area where investors can position from an equities perspective. Also, coming to gold as an alternative asset class, we feel that, historically, and this is something which has been put out by the World Gold Council, that the performance of gold during and after recession is much better as compared, is much better as compared to fixed income products. And given that, we are just tipping into a recession, if at all, there is a possibility that gold can perform better. We still have probably 6 months to go. So if you see, the proof is something which we've already seen in the last 6 months when gold did perform well, and that's largely because of the global slowdown. But we are not near the end as yet. So there is a high probability that gold could perform going forward. So that's one. Next slide. Also amongst the, the chart on the right hand side is the performance of gold during, all the 4 stages of the economy. And if you can see here, gold has, except for a Goldilocks kind of an economy, whenever there has been asset reflation, whenever there has been stagflation, and whenever there is deflation, gold has actually performed well, and it has performed the best stagflation, a situation where inflation is high and growth is low. And even in a situation of deflation, I think these are the 2 best situations historically that gold has performed well. And I think we are currently, when you look at it from a global perspective, we are either looking at a deflation or we are looking at a stagflation kind of a situation. So I think from a short, maybe from a 6 months to 9 months kind of perspective, gold is an option which investors can look at. And I'm talking from a US dollar perspective, and dollar always has been giving us 5% kind of returns in terms of rupees. So that gets added on, to gold as an asset class. So that's, one possible scenario as far as gold is concerned. And gold has, again, some additional data which has been put out by the World Gold Council. They say that gold has negative correlation to global equities during a sell-off, but a positive correlation when equities advance. So whichever way you look at it, gold does well. I think we do not look at gold as compared to equities. We look at gold more as compared to fixed income. And I think gold has delivered better returns as compared to fixed income products. So from that perspective, I think it's a good asset to look at this point in time. Next slide. So one reason for gold, demand picking up has been, if you see, since the year 2010, this is the chart on the left hand side, central banks have turned net buyers of gold. And if you would have read the recent report from the RBI, last 1 year also, they have been, purchasing a large quantity of gold. I think somewhere the central banks, given the new political dynamics across the world, India, China, and some of the central banks have started loading up on gold. And I think that is increasing the demand. Also, with India and China being more than 48% in terms of, almost more than 50% in terms of consumer demand for gold, it is expected that going forward, that demand will pick up as both the economies start running at full steam. There is a possibility that, gold demand from the retail side will also increase. So that's the summary. And again, a slide to show that, gold has been a consistent performer since 1971. And, it can be looked at as an alternative to fixed income from an investor's point of view. So that's it from me. I would stop here, and if Doc is come in, maybe we can.
This is here.
Yeah, wonderful. Doc, over to you.
Thanks, Ashish. Thank you very much. Good afternoon to all of you, and welcome to this brief discussion on markets, economy, and our view on the various products and various market segments. One of the fundamental questions that is asked at this point of time is whether interest rates have peaked out. As far as India is concerned, there has always been a dichotomy. As far as the short end of the yield curve and the long end of the yield curve are concerned, there is a slight difference in the behavior. We have an inverted yield curve, and we know that the short-term rates are quite high, elevated. Though in the last couple of weeks they have started coming down a little bit. Whereas at the long end of the curve, we have, say, for example, the 10-year at around 7.07%. So those rates moved down, and the short-term rates were much higher than the long-end rates. So this dichotomy continues to be a feature of the India domestic local money market. This dichotomy continues, and we feel that this dichotomy could gradually wane away only with a longer pause in the policy and also provision of liquidity by the Reserve Bank of India. But this dichotomy and the inversion of the yield curve is just a transient phase. It's not going to stay for a long time. An inverted yield curve itself is considered a passing phase. Usually it happens before a recession. In India's case, it's not a recession. It is mainly because of liquidity factors that we see this dichotomy. The official policy, as far as we know, it has entered a pause. The second time RBI paused the interest rate hikes. It's the second time they paused. But at the same time, the Reserve Bank of India governor very firmly indicated that if data indicates that the pressure on account of inflation is going to rise, then there could be a hike in the policy. But we feel that that may not be a probable situation because inflation has come down, inflation is moderating. A very high inflation could become a reality only if oil prices move up too much in the overseas markets. Brent at around 76 and broadly in a range of $70 to $80. Oil may not be much of a factor which could put pressure on the local markets. And the rupee is also quite stable to higher nowadays. And so that would also help contain the inflationary pressures to a large extent. So the official policy, we believe that could be a longer pause than we would expect. And that would also give some comfort to the markets that there won't be any major hikes because it's very difficult to go in for a hike after a pause, and that too twice the pause has been taken, and then thereafter it is very difficult to go for a hike in rates. At the same time, a cut also may not come that fast because the observed behavior of central banks is that when it comes to cutting interest rates, the pace is slower, and when it comes to hiking interest rates, the pace is much faster. One of the critical factors that we need to look at this point of time, or when it comes to interest rates, can you go back to the first slide? I'm yet to finish speaking on that. So liquidity, as far as liquidity is concerned, the last liquidity update would tell you that the systemic liquidity is close to around 30,000 crores or 40,000 crores. It's quite low. The systemic liquidity was close to around 1.5 to 2 lakh crores a couple of weeks back, but level. We need about 1.5 to 2 lakh crores on a continuous basis as free liquidity available in the system for the money markets. So the liquidity is precariously low at around 30 to 40,000 crores. This is against the background of the last couple of years when we had 5.5 to 6 lakh crores or 7 lakh crores on a continuous basis on account of government injecting through the Reserve Bank of India plenty of liquidity to the markets. So the liquidity
I hope you all are able to hear my voice because I think Dr. Thomas's voice is not audible.
Yes, I can hear you.
Yes. Okay.
Unmute yourself. You're on mute. Okay, you're on mute. No.
Combat the need to push up demand. RBI may not. Are you able to hear me now?
Yes, sir.
Yes, go ahead. Go ahead.
Yeah, thank you very much. So coming to the, we were discussing liquidity, and liquidity at this point of time is precariously low. At the same time, the Reserve Bank may not be able to take an expansionary step of adding too much of liquidity into the system, because officially, even today, RBI is implementing a policy of liquidity withdrawal, that is gradual withdrawal of the accommodative stance. As we know, inflation is moderating, and inflation has moderated, and the threat from oil prices has also come down to a large extent. When it comes to the primary auctions, the only factor which is exerting too much of pressure on domestic markets and domestic interest rates is the primary auctions, because you know that the government of India's borrowing program is close to around 15.5 lakh crores, and that of the state governments is around 8 to 9 lakh crores. Both put together is quite a substantial amount, and the issues that are going to hit the markets, 65 to 70% of the fresh issues is going to be at the long end of the curve. That's 9 years, 10 years plus maturities. So at the long end of the curve, there will be plenty of issues that are coming to hit the markets throughout the year, which means that that supply will come and sit there, and that will prevent the long end rates from coming down drastically. Therefore, if you are looking at the 10-year yield, it did hit around 696. Now it's back at around 7.07%, and its natural destination is somewhere close to 7.15% to 7.20% is the natural target for the long end of the curve. At the short end of the curve, there could be gradual fall in the short-term rates, though they still continue to be elevated. If you look at the 2 to 3 year time horizon on direct bonds or even on mutual fund portfolios, it's close to 7.5 to 8 and 7.5 to 8%, or even a slightly better around 8.125%. So the primary auctions require a lot of liquidity. Then only the primary auctions will be picked up by the markets. So where is that liquidity going to come from? Unless RBI infuse some liquidity, it will become very difficult for the market to absorb it. So they need to devise some mechanism by which the primary auctions are absorbed. Therefore, it could be either funding, special funding or line of credit given to the primary dealers, or RBI itself picking up some securities for its investment account. All these things could go into adding a little more liquidity to the markets, and which could also help the primary auctions to go through smoothly. So far, there has been no disturbance or any disruption as far as the markets is concerned. But the primary thing which is going to decide the course of future interest rates would be how the liquidity management and the primary auctions are put together, and how the path is smoothened out. We also know that RBI dividend to the government was around 87,000 crores. GST collections have improved, and it's beyond 1.5 lakh crores, but we can't say that it will always stay there, because These GST collections are the product of a 7.2% growth in the economy. If it moves down to around 6 to 6.5%, it may have some impact on the gross GST collections also. Therefore, we need to be very careful on being too buoyant about GST collections as something that would add to the government or help the government finances. But the finance minister has put in a very realistic estimate about the GST tax GDP ratio, which he has taken is quite conservative. And also, we are getting very good FPI inflows. The FII monies have started coming in last few weeks. Last 2 months, we have seen about $8 billion coming in and about $500 million in debt. So it's a very good inflow. But that inflow again has a problem as far as the RBI is concerned, because if RBI needs to release liquidity to the markets, rupee liquidity, RBI needs to go in and buy those dollars. So if the dollar rupee exchange rate, now it has come down to around 81.90, it's close to 82. And if it's not above 82.50 or towards 83 levels, and if it's a shade below 82 also, it gives the RBI an opportunity to go and buy up the free dollars which are coming in because of the FIIs bringing in the monies into India. So they can buy up the dollars, put it in the reserves, and then give liquidity to the markets. So that's also a positive thing. So the RBI dividend, GST collection, buoyancy, FPI inflows, these are also things which would ease or smoothen government finances to a certain extent. But as I had mentioned earlier, the primary auctions at the long end of the curve and the pressure that it could exert on the yield curve has also liquidity would be very critical to the way the direction in which interest rates could move. The policy stance elsewhere, that's mainly in the US, Europe, and UK, is not one of pause at this point of time. The US paused once, but we believe that the US interest rate policy would be would continue to be a little hawkish, and till they find, because their inflation target is 2% and the actual inflation is 4%. So the distance which they need to cover is quite long. Therefore, I think we believe that there could be further hike in interest rates in the US. At least that's what the majority of the economists and analysts are looking at this point of time, because the probability is 75% of a hike in the next Fed meeting. But we need to keep in mind one more thing, that our interest rate policy has implications for our currency also. If we do not hike our official rates, and if the interest rates do not remain high enough, and with a relatively higher inflation, then it could adversely affect the currency, because the currency yield of the US dollar or the pound sterling or the euro, as it moves up against rupee, whose currency yield is much lower, and if we do not keep the interest rates high enough, then it could lead to a relatively higher depreciation in the currency. So from the currency point of view, we need to look at the correct inflation growth trade-off. But I think as far as both Fed and the RBI are concerned, we are somewhere close to the correct inflation growth trade-off, because both by the Fed and the RBI, we have reached a point on the inflation growth trade-off curve, where the trade-off seems to be most appropriate and optimum, which is why the policy in both the US and India, the policy has come to a kind of a pause with a much lower probability of further hikes as we look at it from today. Can we move on to the next slide?
Dr. Thomas, we are running behind time. So can I please request that we end this in 5 minutes and take questions after that?
So you want me to close here?
We can take 5 minutes and close it, because some questions
We can
are
close.
pouring in.
Yeah, we can close here and then take the questions. Thank you. Thanks, Nidhi.
Okay, thank you so
Yeah.
much.
Thank you. Yeah, thanks.
So I think some of the questions that were put up on the Q&A have already been answered. Are there any more questions? You can raise your hands as well. We can unmute you.
Are there any questions?
Yes, Deepak, you have a question.
Yeah, so
Deepak Mondal.
yeah, Deepak
Deepak,
from
please go
Indian
ahead.
Express. Yes. So I missed the first half of the session, but did you talk about the valuation of the equity market in India? Some people are saying that the equity market in India are overvalued now. So how should investors trade in this kind of situation where some people are saying that market is overstrayed, some people are saying that Indian markets command higher premium. So how should investors go about it?
Yeah. So Deepak, the way I look at it is, relative to the historical PEs, India is marginally expensive, but we see India changing going forward from here. Number one, not just being, a growth-oriented economy, but in terms of the structure of India's economy, it is changing quite a lot. So there is a huge amount of investment which is happening in tech and tech related sectors. The infrastructure segment is going through a huge amount of change. What we never used to manufacture before, we have started manufacturing, and I think we are getting more and more ambitious going forward. So, and the fact remains that we are the world's largest consumer market in terms of, just the number of people and the demographics. So I think all of this changes the way the world looks at India and also the way Indians are looking at India. And that is going to have an effect on the markets for sure. And what we are saying is, 2023, if that indeed is the bottom as far as growth is concerned, then you should start seeing growth coming back with the bang next year. So if that happens, there is a very good chance that an Indian market is not just, the top 100 or top 200 companies. Now the market is getting much, much deeper. So even the 600 or the 700th company in terms of rank, I think should see a good amount of growth. And I think valuations there are not very expensive. So I think the market will get more broader and deeper going forward. So, I wouldn't be, worried about just the top few companies being expensive. That's number one. Number two, investors typically are very growth oriented in their approach, and they don't mind paying a very high PE for some of the companies for which they see a really long runway, and which is why we've seen for the last 10 years or rather since the time DMart has got listed, it has always been an expensive stock, and India has many such stories. So collectively, you add all of these stories into the basket is going to look expensive. But beyond these top companies, also there are so many companies where valuations are not very expensive. And I think that's the areas where, money will come in.
Okay. Can I add another question?
Yeah, sure.
Yeah. So this is for Mr. Dr. Joseph. He said that liquidity is precariously low. So what could be the possible repercussion of that?
See, if liquidity is precariously low, because RBI has a very sound money market liquidity management system. RBI needs to keep on adding more and more liquidity into the system. RBI can add that liquidity through primary dealers, through repos on a continuous basis. RBI can fund the primary dealers to buy the primary auction securities. RBI can also take up plenty of government securities in its investment account. RBI can do all these things. Number two, as you have seen, we have seen FII flows are good in equities. RBI can buy those dollars and inject liquidity into the system, because maybe 10, 15 years back, one of the major actions which RBI had taken to infuse liquidity into the domestic market was by buying up the dollars which were coming from the foreign institutional investors. So RBI can resort to that also at this point of time, because the dollar rupee exchange rate is behaving well, and FII inflows have more or less started. So over a period of time, they could infuse liquidity and then subsequently sterilize that liquidity because of the primary auction issues. As far as credit goes, because from the perspective of the economy, corporates or entities who require money, we know that the credit growth at this point of time is around 15 to 16%. And banks have been mobilizing resources, and banks have reported a healthy credit growth. So funds are moving into corporates who require monies or who require liquidity. There is no doubt of that at this point of time. Plus, there is plenty of other things also which would address the needs of the corporates or the SMEs and all that. Say, for example, in the budget itself, there was provision for 20 lakh crores by way of agricultural credit, 10.5 lakh crores of public capex. So all these monies will gradually flow in. So the liquidity requirements will be addressed effectively by the Reserve Bank of India.
So there are a couple of questions in the questions box. So one is from Janki Krishnan. Fed's Powell has indicated that there is likely to be more rate hikes, though they may be smaller. So what would be your take on that, Dr. Joseph?
See, Fed has paused, but the inflation rate is still quite high. It's at 4%. Their long-term inflation target is 2%. So the gap between 2% and 4% is quite a bit as far as the US economy is concerned, because the interest rate sensitiveness of the economy as also markets is very high as far as US is concerned, and it is much less as far as India is concerned. Say, for example, if the inflation rate is at around 3.5 to 4%, whenever it crosses 3.5 to 4%, then the markets, especially asset markets, especially the equity markets, they start falling. They give up market capitalization, they start falling whenever inflation has moved above 3.5 to 4% inflation. So they, for the asset markets also to regain some kind of a momentum and the economy to revive, the inflation needs to come down, which means that there could be another 0.25% hike, or maybe 2.25% hikes in future, which I think may not disrupt an optimum growth inflation trade-off as far as the US economy is concerned. So it's more likely that there could be a hike because inflation is at 4%. Also, the mortgage market is also quite buoyant at this point of time. It needs to retract a little bit and come down, but that requires probably a little more rate action from the Fed, and the mortgage market is very, very important as far as an indicator of the economy, as also for the Fed to pursue the right policies. So we could expect another 0.25% hike probably before the end of the year. That is our assessment of the things.
Okay, so another question we have is from Manish of Money Control. Which option do you think have higher chances that RBI will use to infuse liquidity? Will they use short-term repo auctions before government spending kicks in?
What are those two options? Can you repeat the two options?
So uh, he's asking whether they will use short-term repo auctions before government spending kicks in.
Before commencing?
Before government spending kicks in.
Yeah, see, any central bank, for that matter, Reserve Bank or the Fed, has control over only short-term interest rates and short-term money market. Any policy of the central bank or the RBI gets transmitted through the money market, the short-term money market, to the long end of the curve or the long-term interest rate structure. So a central bank can control only the short-term money market, not the long-term asset market. Through the short term, they control the long term. Therefore, RBI can be expected to resort to short-term repos to infuse liquidity into the markets and thereby manage the liquidity and influence both the short-term rates and also influence the long-term rates. Government expenditure is something that happens on an ongoing basis throughout the year. But in government expenditure, what happens is that government expenditure is targeting two things. One is that it is intended to crowd in private capex, because when IRCT, when the Indian Railways places an order with Bharat Forge or with a Siemens, then there will be a cascading impact of that order from the Indian Railways to smaller entities down the line. So it has a multiplier effect and also a crowding in of the private capex. These are the two things that are achieved. So that it's a long-term process of which happens over a period of 1 year, which is provisioned in the budget. So short-term repos could be an option by which short-term liquidity could be enhanced, because RBI can influence only the short-term money markets and through that to the long term. The government spending, mainly the public capex, will have an impact over a period of time, which will give a boost to business and industry, and it has a multiplier effect as far as private capex is concerned and credit growth is concerned.
Manish has a follow-up question. Is liquidity infusion still required because all money rates are trading lower than repo rate?
Doc, you heard the question?
Sir, again, Manish has another question. He's saying, is liquidity infusion still required because call money rates are trading lower than the repo rate?
Yeah, see, call money rate was higher than the repo rate in the last 2 to 3 months. Call money rate was higher than the repo rate. Say, for example, it had touched even 680, 690 levels. Today, if it is last few days, it has been at around 640 or 650 levels. But this call money is a very short-term indicator of the liquidity, and um, the call money rate could start moving down only if more liquidity comes into the system. See, more liquidity can come in because of Ashish Ranavade in his presentation had mentioned about the withdrawal of the 2000 rupee notes, which could bring in some liquidity into the banking system. Could be about 1.5 lakh crores of liquidity. It's only temporary liquidity because people will deposit the 2000 rupee notes. And banks will get some liquidity, maybe 1.5 lakh crores. It could stay with the banking system for some time. So all these factors, the FII flows, government spending, auctions, all these things will have an impact on the call money market. Now, if the call money market is a market for cash deficient banks to borrow from the cash surplus banks. So it is an interbank market. And it has a very limited function. Then that liquidity could go into expanding the government of India securities, because interbank participants, especially banks, pick up a lot of government of India securities, especially securities at the long end, with funding from the call money market. They can do that. 6.5% call money and maybe 7.25 or 7.5% yield on the gilts. They can pick it up and fund it from the call money market. So it has a very limited function. Liquidity is required because the systemic liquidity at this point of time is only, the last number I saw was around 29,000 crores. So that is not an appropriate liquidity for the local money market, because the local money market would require about 1.5 to 2 lakh crores of liquidity, which is something like a standard liquidity which banks have been borrowing and lending on a daily basis. So once it goes down, then the rates gradually move up. Earlier, when we had a deficit of 50,000 crores or a minor positive surplus of 50,000 crores, the rates moved up. So that was why even the 1 year treasury bill had moved 1.5%, and 1 year commercial papers were. Right now, those rates have graduated them to move down, because 8 to 8.5%, that during the pandemic and all that, it touched 8%, 7.5% moving down. So call money rate at 6.5% or 640 indicates that the market is at equilibrium at 6.5%, including some of the monies which the RBI has lent to the market participants through repos.
Okay, so the last few questions we can take. The next 2-3 minutes we'll wrap up. Any more questions? Please feel free to unmute yourself or raise your hands, or you can type it in the question box. So there's another question from Manish. So he's saying, as we know, RBI was sucking out liquidity when it was in huge surplus and infusing when call money rates went over the repo
I
rate.
think we can close now if there are no further questions.
Yeah, just one last question from Manish. So as we know, RBI was sucking out liquidity when it was in huge surplus and infusing when call money rates went over repo rate. RBI wants the call money rate to align to the repo rate. So in this situation, how much liquidity in the system is required? Dr. Thomas, can you help me? So I think he's having a bad connection. Manish, request you to hold back on this question. I'll first get a response from Dr. Thomas.
it's
and
over?
share it with you.
Is there any question? I'm not able to hear.
Yeah. Sir, Manish had a question that RBI was sucking out liquidity when it was in huge surplus, and they were infusing liquidity when call money rates went over the repo rate. So his question is, RBI wants the call money rate to align with the repo rate. In this situation, how much liquidity will be required in the system?
No, repo rate is a policy instrument. RBI uses that instrument when there is requirement to stabilize the price level or to stabilize economic growth. These are the two, and also stabilize the exchange rate. Economic growth, price stability, and exchange rate stability. These are the three things which RBI would use the repo rate for. It has got nothing to do with the call money rate or the. So the call money rate is an indicator of the equilibrating price, the price at which the lenders and borrowers meet to borrow and lend. That's it. That's a function of that price. All borrowers will get their monies and all lenders will be able to deploy their funds at this equilibrating price, which is 6.5%. That's its function. It has got nothing to do with the repo rate as such. Usually, the call money rate would move closer to the repo rate, because the repo rate is the rate at which RBI lends money. And the reverse repo rate is the rate at which RBI takes money. You got it? So if RBI is lending money at 6.5%, it means that someone should not be taking money from RBI and then deploying it in the markets. So that is the only relationship. Otherwise, repo rate is a policy instrument. It has wider and broader connotations and objectives when RBI uses it.
Okay.
Yeah.
I think with this, we come to an end of our Emkay Wealth Management Media Roundtable. We'll send out the relevant documents and communications shortly. And we thank you. We thank everybody for joining us today and being a part of this session. Thank you so much, everyone.
Thank you. Thank you.
Dr. Joseph, thank you.
Thank you very much.
Sir.
Thanks a lot.
Thank you, Ashish, sir.
Bye-bye.
Thank you.
Bye.
Thank you. Thank you. Bye-bye.